As to valuation of inventory part 2. Let's see what are the exclusion from cost of inventories. So what all things are not included in cost of inventories? The abnormal loss, storage cost, unless the production process requires storage. That means for wine manufacturing and all, the storage is also important, right? So that will be added to cost of inventory. If it is not required in production process, then storage cost will be excluded. So first one, abnormal loss, then storage cost unless the production process requires storage, and then administration overhead which does not contributing to bringing their inventory to present condition and location. If it is not contribute to bringing the inventory to present condition and location, then administration overhead is excluded, and then interest charges and selling and distribution cost. So these five are exclusion from cost of inventories. Let's see an example. Abnormal loss. So there are 1000 units purchased at rupees 100 each, that is total amounts to 1 lakh. And normal loss is 10% and the total good units condition, total units in good condition is 850. Let's see how we will find the cost of inventory. So what is the normal loss? Normal loss is 10%, right? So 1000 into 10% gives 100. 100 is the normal loss. Now what is the total loss? Total unit purchased is 1000 minus number of good units is 850. So 1000 minus 850 gives the total loss 150, and among this 150 the hundreds is normal loss and the remaining 50 will be what? Abnormal loss, right? So let's see how we will account for it. The cost per unit while purchasing was 100. Now since there is a loss and all, we have to find the revised cost per unit. Revised cost per unit is total cost 1 lakh divided by total units minus normal loss. So 1 lakh divided by total units is 1000 minus normal loss is 100. So 1000 minus 100 is 900. 1 lakh divided by 900, 111.11. That is the revised cost per unit. Now let's see, the cost of inventory is 111.11 into number of good units is 850. That gives 94,445. And the remaining abnormal loss will go into P&L. 111.11 into abnormal loss is 50. Number of abnormal losses 50, right? So 111.11 into 50 gives 5555. Total gives 1 lakh itself. Hope it's clear. Now let's see how to find NRV of working process. So here is the question. Cost incurred till date, that is cost of working process is 400 and selling price of finished goods given as 800. Selling cost is 50 and cost yet to be incurred is 200. So how will we find the NRV of working process? We have seen in the last lecture that NRV of working process is NRV of finished goods minus cost of completion, right? So what will be the NRV of finished goods? Finished goods NRV is selling price minus cost of sale. That is 800 minus 50 gives 750. That is the NRV of finished goods minus what? Cost of sale. So NRV of working process is NRV of finished goods 750 minus cost of completion. Cost of completion is what? Cost yet to be incurred 200. So 750 minus 200 gives 550. So that is the NRV of working process. Now what is the cost of working process? Cost of working process is 400. So what is less, NRV of working process or cost of working process? Cost of working process is less, right? So we have to be 400 will be recorded. The cost of working process will be recorded. Now let's see how to find the NRV of raw material. We have seen in last lecture that NRV of raw material is based on the finished good, price of finished good, right? If the NRV of finished good is greater than cost of finished good, then raw material is valued at actual cost. And if NRV of finished good is less than cost of finished good, raw materials will be valued at replacement cost. Let's see. So here in the question it is giving finished good cost is 100 and NRV of finished good is 105. Raw material cost is 10 and the replacement cost of raw material is 8. and the total units is raw material is 100. So how we will find the NRV of raw material thing? We have to see whether NRV of finished good is greater than cost, right? So let's see what is the NRV of finished good. 105. It is greater than cost. If NRV of finished good is greater than cost, we will value the raw material at what? Whichever is less, cost, right? We will value the raw material as cost. So what is the raw material? There are total 100 units of raw materials, and what is the cost of raw material? 10. So 100 into 10, 1000 will be the answer. Now let's see what are the different cost techniques. There are 5 cost techniques: specific identification method, FIFO, retail cost, weighted average cost, and standard cost. What are they? Specific identification method, FIFO, retail cost, weighted average cost, and standard cost. Now let's see allocation of cost, joint products and byproducts. How will we allocate for joint products and byproducts? Example, the crude oil process, there are 10,000 barrels, rupees 50 lakh. The petrol and diesel are joint products. Petrol 4,000 barrel, selling price is 7,000 per barrel, and diesel 5,000 barrel, selling price is 6,000 per barrel, and byproduct is tar 1,000 barrel, selling price is 1,000 per barrel, and the cost of sale of tar is 1 lakh. Let's see how we will allocate for the joint product and byproduct. For that, there are different steps. The first step is to find the NRV of the byproduct. NRV of the byproduct is sale minus cost of sales, right? So NRV of tar is, what is the selling price of tar? There are 1,000 barrel at 1,000 each, right? So selling price is 1,000 into 1,000, and minus cost of sale of tar is 1 lakh. So we will get the NRV of tar as 9 lakh. The second step is to find the remaining amount. We have to subtract total cost minus NRV of the tar. So second step is total cost minus NRV. 50 lakh minus 9 lakh is 41 lakh, right? The remaining cost is 41 lakh, and we have to divide the 41 lakh among the petrol and diesel joint products on the basis of sales ratio. So what is the sales ratio? What is the sale value of petrol? Petrol, there is 4,000 barrel at 7,000 per each. So what is the sale? 4,000 into 7,000, 28 lakh. And for diesel, what is it? 5,000 barrel at 6,000 each. So 5,000 into 6,000, 30 lakh. So it is, petrol gives 28 lakh, diesel sale value 30 lakh. So we have to divide it among the ratio 28 is to 30. So 41 lakh into 28 by 58, and here 41 lakh into 30 by 58. What is this 58? The total 28 plus 30 gives 58. So we will get the cost of petrol as 19.79 lakh and cost of diesel as 21.2 lakh. Now we can also find the cost per unit. Petrol cost 19.79 lakh divided by number of barrels of petrol is 4,000. So divided by 4,000 gives 494.75, and diesel, the total cost is 21.2 lakh divided by number of barrels of diesel 5,000. So 21.2 divided by 5,000 is 424. This is how we allocate the joint products and byproducts. First we will find the NRV of the byproduct, and then we will reduce spread from total cost. Total cost minus NRV, and the remaining amount is divided among the joint products, petrol and diesel, in the sales ratio. Now let's see what are the disclosure requirements as per AS2. Accounting policies for inventory measures have to be disclosed, and total carrying amount of inventories with classification to finished goods, raw materials, and working process. So these are the two disclosure requirements as per AS2. First we have to disclose the accounting policies for inventory measures and the total amount carrying amount of inventory by classifying it into finished goods, raw materials, and working process. Hope it's clear.